Hi, my name is Matthias Allred. Thanks for joining us today. We're going to be talking about the FHA Streamline Refinance process and the transaction details so you get a better idea of how these FHA transactions work. Okay, it's a great program designed to help you lower your interest rate while creating a lower doc loan. Okay, the qualification process is very simple and very easy. We'll go through those qualifications. We'll go through some of the things that you need to know about the transaction details and what's going to happen. And then we'll show you how to get started on that. So first and foremost, FHA loans were created to help, FHA Streamline Refinances were created for those borrowers who have an FHA loan who want to take advantage of lower rates, but they don't want to or don't need to go through the entire refinance process. Okay, FHA has made that refinance very simple and very easy. Okay, a couple of qualifications to qualify for the program is that the house has to be, you have to currently own the house. Okay, real simple. They want to make sure it's your house that you're going to qualify for. Now keep in mind, this does not have to be a primary residence. Okay, if you bought a house years ago with an FHA loan and have since converted it to an investment property, you can still take advantage of the FHA Streamline. Okay? Second qualification is that you have to be current on the mortgage payments. And you can't have any late payments for the last 12 months. Okay? So as long as you're making your payments on time, you have an FHA loan, you qualify for the loan, you're in good standing for this program. Okay? An important part of this program is that you have to save at least 5% by doing the refinance. Okay? That's actually good advice anyway. You don't ever want to refinance where you're not saving any money. Okay? So saving 5% is very common, very important. Okay? The fourth thing right here is you do have to have a job. FHA wants to make sure that you own the house, you're current on the payments, you're still working, you still have a job. We'll get into a little bit further, but we don't have to document all of your income for your job either. Okay, you do have to have a minimum 620 credit score to qualify for the program. Again, if you're current on your payments and current on your other bills, you shouldn't have a problem getting that credit score. But we do require that you have a 620 credit score on here. And then the last thing is that if you have to come to closing with any money, we do have to verify assets. Okay? So if you're coming to closing with any money, we'll verify that. But other than that, that's the whole qualification process. If you meet these and you qualify for an FHA Streamline, you can take advantage of the lower interest rates and save money on your loan every single month. It's a great program. Okay, I guess I should point out, you do have to have an FHA loan to qualify for this. If you have another type of loan, such as a conventional Fannie Mae, Freddie Mac, if you've got a USDA loan or a VA loan, they all have different refinance programs. A lot of those have a streamlined process on their refinance as well. But for the FHA Streamline, you do have an existing FHA loan. Okay? Two things that you don't have to worry about with these streamlines is an appraisal, which is really great, especially in today's market where you've seen a lot of houses declining. Okay? We don't require an appraisal at all on this. And income docs. Okay? We do have to verify that you have a job, but we don't have to collect full documentation on your income, meaning we don't have to get pay stubs, tax returns, W-2s, anything like that. So it's a light documentation loan. It's designed that if you have an FHA loan, you're current on your payments, there's no reason why you shouldn't continue on those payments. You're going to qualify. So no appraisal, no income. Two very huge things that make this a very easy loan. Okay, obviously along with that, we don't have to do a lot of the verifications and behind-the-scenes processing for that. And so you're going to find out later that the fees for these loans are also a lot lower too. Okay? So let's go real quick with an overview on FHA loans. There's a couple of things I want to talk to you about that you need to understand on FHA loans. Okay, first thing is that all FHA loans have an upfront mortgage insurance. Mortgage insurance premium. Okay? This is collected on every FHA loan, whether it's a purchase, a refinance, or a streamline refinance. FHA will always charge an upfront mortgage insurance. Okay, currently, right now, the upfront mortgage insurance is 1%. Now, FHA changes these periodically. It doesn't happen often, but they do change. I've seen it as high as 2.5%. Currently, it's at 1% right now. The way this works is that that upfront mortgage insurance typically gets added on to the balance of your loan. So if you had a $200,000 loan, and the mortgage insurance, upfront mortgage insurance was 1%, that would be $2,000. Okay, your total new loan amount is going to be $202,000. Okay, it's added on there. Typically, you don't pay for that at closing or pay for it out of pocket, although you can. But most people choose to wrap that into the loan. Okay, the second thing we're going to talk about is your monthly mortgage insurance. Monthly MI. Okay, All FHA loans have a monthly mortgage insurance, and that is going to be for a minimum of 5 years and 80% loan to value. Okay, loan to value is mortgage talk. It means how much equity you have in your home. So if you have 20% equity in your home and you've had this loan for 5 years, that monthly mortgage insurance is going to drop off. Okay? So keep that in mind when you're thinking about your total payment. 5 years down the road, that mortgage insurance is going to drop off. Okay, the third thing that we want to talk about is the interest charge. FHA is unique on this in that they charge interest for the entire month that you have the FHA loan. Okay, what I mean by that is that if you order a payoff and you're going to pay off your loan on May 5th, for example, your payoff will actually calculate interest through the 31st of May. Okay, you're going to pay the interest for the entire month that you had that FHA loan, even if you didn't have that loan through the end of the month. Does that make sense? So you pay it off on the 5th, but you're still paying a whole month's worth of interest. It's one of the things about FHA that's unique and different. So what we like to do is we like to close FHA loans at the end of the month. So say you ordered your payoff for the 30th, you'd be charged interest for till the 31st. You'd only pay 1 day of extra interest on that if you closed at the end of the month, as opposed to paying 26 days of extra interest. That could be several $100s depending on your loan type or loan amount. So interest charge goes through the end of the month. Just keep that in mind. That plays a big factor when we're refinancing your FHA loans. Okay, one other thing I want to talk about real quick is your total payment. And this is with any loan, but especially with FHA. Okay, we're going to talk about your total payment is PITI. Okay, this stands for principal, interest, taxes, and insurance. And on your insurance, you usually have a hazard insurance and your monthly mortgage insurance, okay? Your MI. So let's just run through an example real quick. Say you had a principal payment of, what have we put on here, $785. Okay, that's principal and interest. You'll notice on your mortgage statement, when you look at that every month, it'll show you what's the principal and interest, what's the taxes, let's say that's $110 a month. Your hazard insurance is $45, $165 on your mortgage insurance. Okay, that gives you $1105 payment. Okay, that's your total payment that's due every month. That's what you send to the mortgage company. But this taxes and insurance is set aside for your escrow account. Okay, so this right here is what's called your escrow account. We can even spell right here. Escrow. Okay, this money right here is set aside into an escrow account. So every month that you pay that, this money is going in here and being built up so that when your taxes become due in November, they have money set aside to pay your taxes. When your hazard insurance premium becomes due, they have money set aside for that. And the mortgage insurance, the mortgage insurance gets paid out every month. So they'll collect it in your escrow and they'll pay it out every month to FHA. Okay, so keep in mind the 5-year period that you have to pay mortgage insurance, 5 years, and when you get to 80% loan to value, this mortgage insurance is going to go away. Okay, so your payments actually going to go down there. Okay, but here's an overview of your total payment, principal and interest, taxes, insurance is part of your escrow account. Okay, now when you're calculating the 5% savings that you need to save to qualify for an FHA Streamline, you're going to look at the principal and interest and the monthly mortgage insurance. Take out the taxes and the hazard insurance because that's your personal money that goes to pay for the fees or services that you have to pay for. It's not really part of the mortgage payment or repayment process. Okay, so we use principal and interest and the mortgage insurance to qualify to meet that 5% savings right there. Okay, real quick then, let's go over the Streamline transaction itself. So we've given you an overview of FHA, some of the important things that you need to know about that, how your payment's calculated. Let's go over the actual details of the transaction. Okay? So on these transactions, first we want to talk about what can be included in the new loan and what's not going to be included. Okay, so when you have your old loan, we're going to order a payoff from that, OFF. And the payoff's going to include a principal amount, going to include interest, and then include some other fees. Okay, there's usually a payoff fee or a fax fee or something like that that your old lender is going to charge. And that's what they send us on the payoff. Okay, on your FHA, your new loan, when we're calculating your new base loan amount, we're going to count the principal we're going to count 1 month of interest, but we're not going to be able to count any fees in calculating your new loan amount. Okay? We're also going to include the new upfront MIP, okay, the new upfront mortgage insurance. Okay? And then you're also going to get a credit for the old mortgage insurance premium that you paid getting this old loan. Okay, so when you got this old loan, you paid an upfront mortgage insurance premium when you got this loan. And let's say, for example, it was $1,600. Okay, you paid the upfront mortgage insurance of $1,600. That's added onto your loan. It's factored into your principal balance right here. When we calculate the payment for your new principal balance, we're going to charge your new upfront right here. Okay, but you already paid this. Say you just did this a year ago. Okay, you bought this home a year ago. You already want to streamline refinance that. You may have paid $1,600 here, but you're going to get a credit back of, say, $1,000. Okay, FHA is the one that determines that. They have a scale, a prorated scale, that they tell us what kind of refund you're going to be getting, and they'll tell us the new upfront is 1%. Here it is. The refund. Excuse me, I dropped my pen. The refund from your previous upfront mortgage insurance is $1,000, and so we're going to actually only add $700 onto your new loan. Okay, so to calculate your new loan amount, we're going to take your principal, we're going to take 1 month's worth of interest, we're going to take your new upfront mortgage insurance, and then we're going to minus out that credit you get, and that's going to be your new principal balance on your loan. Okay, so new balance, or new loan. That's what your new payment's going to be based off of. You're going to be making your payment based on the new lower interest rate on that as well. Okay? So a couple of things that we cannot include on that. Okay, we can't include any fees. So we're going to cross that out. We can't include any fees in that new loan amount. You can't wrap any of your closing costs. Okay, we can't wrap those into the new loan. You can't wrap your new escrow account. Okay? We cannot include any of that into your new loan amount. Okay? So that's one of the restrictions on FHA. They do that so that you're not constantly refinancing, adding all of those fees onto your loan, and getting a higher loan amount, and actually going further and further into debt because of your refinance. It's really great that way. They only include the principal and the 1 month's interest, and then the FHA fees at all. So anything else, the bank payoff fees, closing costs, escrow account, anything like that, cannot be wrapped into your loan. That's actually great for you and prevents you guys from getting into further and further debt with your mortgage. Okay? Now, that does pose some problems because there are closing costs, escrow account, and actually fees associated with getting a new loan. Let's run over those real quick. You remember the first of the class, we talked about how this Streamline is a reduced documentation loan. It's a light doc loan. There's a lot of things that we don't have to collect to qualify for these. Okay? Typically, on an FHA purchase, on a typical purchase or a typical refinance where we have appraisal and income and all of that kind of stuff that we have to verify, we usually charge a 1% origination fee plus lender fees of $1,320. Now that's underwriting, processing, doc prep, flood certs, all of that kind of stuff wrapped in there. So if you had a $200,000 loan, $200,000 purchase price or $200,000 loan, you would actually pay the $1,320 in fees. You'd pay $2,000 origination. So your actual lender charges would be $3,320, okay, in lender fees. That's typical on a purchase, typical on a refinance, but not typical on a Streamline. Remember, this is a reduced documentation loan, and so the process is a lot simpler. There's less that we have to verify and less work that we have to do on the files. And so instead of charging this $1,320 on our Streamlines, we're actually only going to charge $600. Okay? It's a great savings for you. It's a great way to refinance and not incur all of the costs that you typically would on a refinance. Okay? So remember, you're saving money right there. So your closing costs are low. In addition to our origination fees, you're going to have title fees. Okay? We'll order those from the title company. That's going to be your new title insurance, your new closing fees, recording fees, all of that type of stuff. Okay, so you're going to have our lender fees, title fees, plus the new escrow account. Okay? With the new escrow account, we'll get into that in a second, but that's going to be the money that's required to set up that escrow account to make sure your taxes and insurance are paid when they become due. Okay, these are all the fees that are associated with closing your Streamline refinance. Now you remember, we said that we could not wrap any of these closing costs and these fees into the new loan amount. So they've got to be paid at closing, either through a lender credit from us or through borrowers bringing in some money. So there's a couple of options that you have that way. Okay, the first option is the absolute lowest rate plus your fees. Okay, so you'll talk to us, give us a call. We'll let you know what the absolute lowest interest rate is and let you know what the fees are that's associated with that. Now, again, keep in mind you're going to be bringing that money to closing, and so you want to make sure that if you're bringing that closing, that you have that money that we can verify in a bank account so that we know you're good to close on that. Okay, it's kind of hard for a lot of people to come up with that much money at closing. Remember, it's a lot less than a purchase transaction, but you're still going to be, $2,000, $2,500, depending on your escrow account and your taxes and so forth. Okay, so here's your first option. Your second option is to take a low rate or a lower rate plus no fees. Okay, we give you a lender credit because we can charge a slightly higher interest rate, and we can actually cover all of those costs for you. So when you come to closing, you're not bringing any money at all to closing. Okay, so there's your two options. The third option is what most people choose to do, and that is to take a lower rate. It's not maybe the lowest, but it's certainly a better than what you would if you're doing no fees at all, and some fees. Okay? This is what most people choose to do. They still want to get a great interest rate. They're still saving money every month. They're saving at least that 5% or more, and they are going to pay some of the fees. Now, typically what we see people doing is the fees that they pay are about equal to what their 1 month's housing payment typically is. So if your housing payment is $1,100 a month, say it was $1,105 in our previous example, okay, and your total closing costs that we talked about are, say, $3,200, okay, at closing what we would do is that we would give you a lender credit for the $2,100, and all you would bring to closing is your 1 month's worth of payment, okay? That's typically what happens. So you're going to bring about $1,000 or about your payment's worth to closing, $1,100. We're going to credit everything else from the lender side. You're still getting a low interest rate. You're going to save at least 5% or more on your payment, and you're not adding all of those fees to your principal balance, which is really great. Okay, the other thing to keep in mind is that when you do a refinance transaction, you're actually going to skip 1 month's payment. Okay, so if we closed your loan on May 31st, okay, you're going to have a payment due in June. You're actually going to skip that. And your first payment is going to be due July 1st. Okay, so we're closing in May. You're going to bring this payment's worth, this $1,100 to closing at the end of May. You're going to skip June's payment. And your first payment is going to be due July 1st. Okay, so as far as cash flow out of your pocket, you're really not coming out of pocket more than you would otherwise. Okay, and so that way you can still get that very low interest rate. Okay, now the other thing I want to talk to you about real quick is how we calculate some of those closing costs, especially your new escrow account, and what happens to your old escrow account that you get from your previous lender. Okay, so remember, with your old lender, you've got your PITI payment, right? PITI, this taxes, insurance, insurance right here, is your escrow account. Every time you've made that payment, all this money gets set aside in your escrow account. Okay, so this balance actually starts to increase as you make those payments. Okay, so on your old lender, you can actually look on your mortgage statement. They'll tell you how much you have set aside in escrow. If not, you can go online or you can call them and they'll tell you what your escrow balance is. It can be anywhere from a couple of $100s to a couple of $1,000, depending on your taxes, depending on your insurance, and depending on the time of year that you're doing that. Okay, so this money is set aside. This is your money. Your money. Okay, that's money that's set aside that you've paid as part of your payment that's set aside to pay your expenses. Now, when we set up your new loan, we're going to set, you're going to have your same PITI payment right here. The same taxes and insurance are going to be collected. We're going to have to fund your new account so that your new lender can actually pay those taxes and insurance when they become due. So depending on the time of year, we might have to collect more for taxes and insurance than we would say may have to do at a previous time. So county taxes are due in November. So if we closed your loan in October, we would have to collect at least 12 months plus 2 to 3 months in reserves for your escrow account. So you can imagine 12 months plus 2 to 3, say you're collecting 15 months worth of taxes, that can be a pretty large sum of money that we need to collect for your escrow account. Okay, conversely, if we were closing in January, for example, your taxes were just paid in November, we're going to collect those, we're probably only going to need 3 or 4 months worth of taxes as opposed to 15. Okay, so depending on the time of year, can really make a difference on how much is collected. Now also keep in mind though, that if we were closing in October, if we had to collect 15 months worth of taxes, that means you also have, close to a year's worth of money that's been going into this escrow account. Okay, remember, this is your money. This is going to get refunded to you when you close on your loan. So the more we have to collect up front for the new loan means the more that you're going to get back from the old loan on your escrow account. Okay, so we set this up. Same with your insurance, depending on when the insurance premium renews, will depend on how many months we have to collect. We always try to keep that buffer in there so that there's enough money to pay your taxes and insurance when they become due. Okay, but like I said, the money in your old escrow account is yours. So whatever's in there, 2 to 3 weeks after we close on your new loan, they're going to send you a check in the mail for all of that money. Okay, so you can go do with it whatever you like. You can save it, you can invest it, you can take your wife or husband out to dinner, a fancy trip. You can pay down the balance on your new mortgage. Whatever you'd like, that's your money. You can do with it as you need to. Okay, just keep in mind we are collecting new escrows for the new mortgage insurance, or the new loan that you're getting right here. Okay, I think we touched on this, but remember when we close on your new loan, you're going to skip 1 month's payment. So if we closed at the end of May, you're going to be skipping June's payment. Your next payment's going to be due July 1st with the new loan. So you are skipping 1 month's payment right there. You are going to be getting an escrow refund, and that's money that's going to go back into your pocket. And that helps make the whole streamlined process easier for a lot of people. Okay? So how to get started? Again, if you meet the qualifications, you have an FHA loan, you're paying on time, you want to get a lower interest rate, just give us a call in our office. Again, my name is Matthias Allred. My phone number, you can call me on my cell phone directly. It's 801-361-2596. Give us a call. We can run through the application in about 10 minutes over the phone. We can run all the numbers and make sure you're saving enough money, make sure you qualify, make sure this is going to be a good refinance transaction for you. Again, we only want to do loans that's going to be a benefit to you. We want to put you in a better spot with your new loan. So let us know if you're interested in this. Do us a huge favor. Forward this on to your friends and family and those people who could also take advantage of low rates. Interest rates are unbelievably low right now. And if you can lock into a 30-year fixed loan at 3.75%, wow, you're just going to save so much money over the life of the loan. Talk to your parents. They remember getting loans at 8 and 9% and thinking that that was just outstanding. So these low interest rates are great. Again, do me that favor. Share this with your friends and family. Have them give me a call. We can get started on this whole process in about 10 minutes. There is some documentation you will have to send me. You can find that right down below this video. Just click on that. That's our items needed list. I'll also email that to you when we get started. Excuse me. If you want to send that in to me, we'll get started. The whole loan process takes about 7 to 10 days is all. So again, it's a light documentation loan. Very easy to do. It's going to save you money. 7 to 10 days, we'll have you closed up and getting into that new low interest rate. Hey, appreciate you taking the time to stop by with us and watch this class. Let us know if we can ever do anything for you, and we'll talk to you soon.